Hi, good evening, everyone. While we wait for more people to join in, let me share with you our latest product, UCash. UCash is a cash management service by UOB Kay Hian that lets you earn 0.8% for SGD and USD per annum on your trust monies while you wait out on investment opportunities. Simply enroll and put your monies in your trust account. Interest will be paid out and reflected at the end of the month. There are no minimum sums, no lock periods, and no charges. UCash is available both in SGD and USD. Sign up today and start earning interest on your idle monies as soon as next week. To find out more, please scan the QR code on the screen. Details of UCash can be found on our website, utrade.com.sg. We are also now on Telegram. Do remember to join our channel, UOB KH Trading Ideas, for the latest market insights and promotion, simply by scanning the QR code on the screen. So back to tonight's presentation. We'll be hearing from Ms. Shaldine Wang on Elite Commercial REIT, a unique social infrastructure play. Follow which, there will be a Q&A session. You may send your questions to us via the chat box. We will also appreciate if you take a few minutes of your time to complete the survey form that will pop up after the session ends. So without further ado, I'll hand over the time to Shaldine. Hi, Shaldine.
Hi, thanks. And good evening. Hi, Juan. Thank you for taking time this evening to join us. What I'll do is that, I'll go, like what we said, we'll go through the presentation, but here I would like to introduce my team. So as you can see, we have Jonathan Edmonds, which is our CIO, seated in the UK now, joining us this evening. We have Joel Cha, which is our CFO. He will be joining us in the Q&A session as well. And also we have Hong Ying, which is our IR in charge. So let me just quickly run through this and we can then answer any questions that you would have through this. Can I have page 4? Thank you. Right. I'm cognizant that some of you might not be that familiar with us. So I'll be a bit long-winded in terms of a bit of the basics of our REIT. So I guess what we are today is that Elite Commercial REIT was successfully listed onto the Singapore Stock Exchange on the 6th of February 2020, just before the onset of the COVID-19 pandemic. So we are the first and only UK-focused Singapore REIT, and is actually backed by a sovereign tenant. So over 99% of our properties are let to the AA credit-rated UK government and are being used as crucial social infrastructure for the country. So our properties are very well diversified across the whole of the country. As you can see on this map here, we have all these little dots. These are where all the assets are located, mainly on the lighter gray area, which is the more densely populated area of the country. Our portfolio is 100% occupied, so we don't have any vacancy in our portfolio. We initially listed the REIT with 97 assets in 2020, and subsequently we did a maiden acquisition this year, and now the portfolio has 155 assets in total. The portfolio valuation stands at about £515.3 million. A majority of the assets that we have sits on freehold land, with only 5 properties sitting on long leasehold. So the leases are all let on a full repairing and insuring basis, which in Asia we quite commonly term that as a triple net basis. And the majority of them actually comes in with a built-in rental escalation that is linked to inflation, which is the CPI index. So next page. These 5 points that we have listed here are the key investment merits for the REIT. We will go through it in a little bit more detail later, but mainly there are it has a very well diversified asset base. They are actually, like what I said earlier, crucial public infrastructure for the UK government, and they are all very well located properties, which also the REIT has got also a potential of future growth, which we can touch on later. Next page. Right, so in terms of attractive yields, as we've mentioned earlier, 99% of our assets are being lent to the UK government. So it provides a very defensive and recession-proof yields, that is actually proven itself during this COVID period. We have always been providing very steady and higher than our forecast yields to our investors. The portfolio yield spread, as compared to, say, for example, a 10-year UK bonds, government bonds, which is trading today, there is actually a huge difference in terms of the yield spread. We are looking at something close to about 530 bips, where both of these types of investments are all backed by the government itself. And on top of that, the portfolio has got its built-in rental escalation. So which means that, other than providing these returns, there is also a potential for an increase in rental income in the portfolio. And based on the current CPI forecast that the government is having, we do see that on an average, for the 5 years that we are talking about, that we envisage the increase to come in, because the new rental rates will kick in on April 2023, as all the leases are signed in end of March, in April 2018. So there's a 5 years. So we're looking at probably, conservatively 7 to 8%, but it's definitely looking at the current situation, we are envisaging that this will be higher than that. So, but if you look at it on the government forecast, on average, the CPI index is probably going to be standing above the 2% level for the next, for this year and also for the next 2 years. Next page. So we have talked about the government buildings and being used as crucial infrastructure. So what are they? Because the network of the assets are so well diversified across the portfolio, across the country, and well located, all because of this particular nature of the use of this government body. A majority of our assets are led to a department called Department of Work and Pensions, commonly termed as DWP in the UK. They support the social fabric of UK because they provide a few of these very important services to the country, which is actually the welfare, the pensions, and also child maintenance policy. So which means that, majority of the work is that actually they are providing these to the people. And this is the largest public service department in the UK. Particularly if you look at the baseline requirements for the country, definitely if there's no financial or basically economic downturn, there's always people claiming on pensions, which is the growing elderly populations, people providing help to these pensioners. They can also claim on the government. Then there is disabled people who has been able to claim, as well as people supporting them. Of course, when situations such as the COVID-19 pandemic or the great financial crisis that we see previously, there is actually an increase in unemployment. So there will then be a upsurge in the needs for unemployment benefits. So as of the last financial reporting year from the government, which has ended March 2021, it recorded over 22 million people actually claims on DWP, and the benefits that they have provided to the people, it's more than 212 billion pounds. And these are being served. These people are being served out of the Job Centre Plus that we own a quite a hefty number of these centres. So that's why it provides a very strong and integral part of the whole UK social fabric. And of course, with this pandemic situation, we do also see that the government has responded to the needs of the people. They have actually increased the number of people working in these centres by doubling the work coaches. So as of early this year, they have actually completed recruiting another additional 13,500 work coaches. So all the centres remains open during the various lockdowns that we see in the UK. It's just that they have to adjust the timing so that to cater for social distancing and the needs as well. And there is actually no force majeure clause or termination clause in the leases with relates to situation as such. Despite that. So this is what's happening of the tenant, and this is how the tenants have used the buildings. So next page. So the buildings that we have that are let to this major tenant constitute two portions. One is the front of house, which is what like front office, and then also the back of house. So the front of house is actually the face-to-face interaction place whereby a claimant will come to seek help, in terms of registrations, in terms of the needs. For example, if they're unemployed, they will come and see the work coach to build them a back to work plan. They will do trainings at the centers as well. So these are the things that are being actually operated out of the centers. And some of the buildings that we have also comes with medical examination rooms. These are not normal clinics. They are fitted with equipments and also with professionals to assess whether these people qualify for the disabled benefits or not. Then the other portion of our assets, which is actually the back of house, that actually constitute things like the call centers, the fraud detection centers. It also houses one of the only passport center in the whole of Scotland. And we also have one of the big IT development center, which is the center that develops the whole online payment system called Universal Credit for this particular department. Next page. Well, so much about the major tenant itself, but apart from that, our assets are all very well located. Now, this is very important because there is certain needs by the government. The government has pledged to the citizen that everyone should be able to access to one job center plus within 25 minutes of their transportation time. So these job center plus are usually located at easily accessible areas. They are either at the town centers of city centers. There is always a bus stops right in front or next to the building. There is always a train station, if that location have a train station, which is within walking distance. And there is a lot of amenities around the area. Now, these are all the key considerations when you looked at investing in the property, whether this proximity or locations of these assets are. So even if one day, should the government decides that they are no longer going to need this as a government building, there is always a lot of other opportunities or a lot of usage, or it can be used, let out to other users as well. Next page. For people who are probably not familiar with Elite Commercial REIT, we do have three sponsors. So the three sponsors are namely Elite Partners Holdings, Holy Group, and Sunway RE Capital. So they are all experienced investors and also sponsors for various REITs. They have also got proven track records in terms of supporting other REITs as well. So Holy and founders of EPH were previously founded Viva Industrial Trust, and of course Sunway RE Capital has got its own Sunway REIT under the group that is listed on the Bursa. So this continues to be very supportive, and they have been supporting the growth of this particular REIT throughout the past 2 years of our formation as well. Next page. Right, I guess this particular chart just shows the various key milestones that we have achieved since the listing. We were listed on the 6th of Feb. We have continuously and I would say that continuously outperform all the forecasts that we have put in our prospectus on every announcement on our results or updates. We managed to complete a maiden acquisition within a year from the listing, increasing the AUM of the portfolio to close to 1 billion Sing dollars. We have also completed the first technical listing of S-REITs, Singapore REITs, onto a TSE stock exchange, where then it actually allows us to be at par with in considerations as all the rates of other UK REITs as well. We have also been able to show very strong governance in our first evaluation by the Governance Index for Trust this year. We were ranked jointly ranked 6 among the 45 REITs and business trusts in Singapore. Next page. A bit more on the Q3 results. This is what we have last announced. Like I said, we have always outperformed our forecast and projections. We have been continuously announcing the outperformance and beating revenues and also distributable income projections. The 3Q distributable income for unit holders was recorded at 7.1 million, which is actually 70.6% increase from our original IPO forecast. This is mainly contributed by the newly acquired portfolios onto the REIT. And in terms of DPU, that is reported at 1.48 pence, which is 20.3% higher than the actual of last year, same period, and also the IPO projections. Next page. So for the last quarter, we have actually achieved several key milestones in order to enhance our financials and to continue to build a very resilient portfolio. The next few pages of the slides will then brings out the details of these few points that I've listed here on things that we have achieved. Next page. So in terms of financials, I have mentioned earlier, well, because we are a listed REIT, we are required to show the comparison against the actual, against both the projections and also actual. In both cases, we have outperformed. Our actual revenue for 3Q is 9.4 million, and this is 60.4% above the IPO projections. And on a 9-month basis, this is 45.4% above our projections. Then our distributable income for 3Q stands at 7.1 million, which is 70.6% higher, like I've mentioned earlier. And on a 9-month basis, this is 48.4% higher. And the DPU stands at 1.48 pence, which is 20.3% higher than projections, but also 12.9% higher on the 9-month basis. Next page. This is quite similar. It's just the requirements to compare to the actuals that we have achieved in 3Q 2020. Next, in terms of balance sheet, the non-current asset stands at £516.5 million as of the end of September, and it's probably that's approximately about 956 million Sing dollars, so about a billion Sing size. Our NAV per unit is recorded at 63 pence. Next. This particular slide has a pictorial chart of our debt maturity profile. We have also used some of the proceeds from our maiden DRP to retire some of bridge loans, so it helps us to provide a more stable financial position for the REIT. Our total debt stands at £225.6 million. Our average borrowing cost is about 1.9%, the interest coverage ratio at 6.2 times, and we hedge about 63% of our debt. Next. This is something a bit more interesting, as this was something that we tried to do, and it's an achievement because we are trailblazing here. No one has actually done this before, but we managed to get ourselves successfully technically listed on TSE in August 2021. Now, what does this mean to us? One, that means that Elite Commercial REIT entities now has joined the UK REIT regime. This allows us to have the same kind of tax treatment as other UK listed REITs. So as a UK listed REITs, we are exempted from paying the UK corporate taxes, and instead what we pay is the withholding tax on dividend. Excuse me. So this means that immediately we have a reduction in our tax rates from 19% to 15%. And this will translate to more income available for distribution. Now, that is not only the only advantage. The technical listing also allows us to eliminate any deferred tax liabilities in our REIT, and hence actually in our books, and hence actually our NAV increases as well. And since it's a technical listing, the shares of the entity that was listed was wholly held by Elite Commercial REIT, so there's actually no tradings of the shares of the subsidiary on the stock exchange. Next page. Now, apart from the immediate effects that stated in the previous slides, This corporate moves actually allows us to achieve 3 major points. So one, it future-proofs the REIT from any future tax increases which the government has already announced. So it has been legislated that the corporate tax is going up to 25% in 2023. So, although we are seeing an immediate 19% reduction to 15%, in actual fact, we are preempting what's going to happen, which is actually the further increase in corporate tax, which is going up to 25% in 2023. The second point is that when we acquire assets in the future that are held in SPVs, any unrealized gains upon entry into the REIT will be eliminated. And when we sell assets, any future tax on latent capital gains is also expected to be eliminated. So this moves actually future-proofs the REIT and enhance the efficiency of the structure. Next page. So much on the financial and the structuring part. On the property side, I would say that the REIT is pleased to always announce that we have achieved 100% advanced rental collection for Q4 this year. This provides assurance to investors on the next quarter distribution. We have always been very consistent since listing in terms of our collection, our rental collection and distribution, because we have tenants, which is the UK government, that has been paying their rental in full and on time. So it is actually, I would say, a very unique or probably more to say, a very proud achievement under the current market conditions. Our WALE stands at 6.4 years. We are ramping up asset management efforts on various fronts. The 2 incidents that has been announced in the last quarter was one, we have negotiated a 7% increase in rental rates for one of the buildings, which is Dallas Courts units. And we have also evaluated the options for, we are also evaluating the options for John Street, Sunderland, which there were, the lease break options was actually been served. So this is 2 key lease events that happened in the last quarter. So the next page. Next page. Okay. I think we've announced this earlier. The Epsom property. The lease breaks were served by the government, and we also have received an offer to buy this particular property at a valuation 21% above the valuation. However, discussion is also ongoing with DWP as there is indications of them wanting to remain as a tenant as well. So both options are being evaluated. We are very close to coming to the finalization of this, and we will definitely revert back to the investors in terms of the decision of this particular property. But in any case, both are actually a better options, outcome for us on this particular assets. The next page. This is actually the lease expiry profile for the REIT. We not only produce a lease expiry profile to show the lease to the expiry, we actually went above to also show the lease that has got options to investors. So the majority of our leases were signed on a fresh 10 years back in 2018. So as typical of most 10-year leases, there is a 5 years break clause embedded in the leases. So if you look at the 2 bar charts here, the lighter one refers to the expiry, whereas the darker blue actually refers to the break options. So managers has been actively working on the asset management steps to come to a conclusion. Well, we would want to see that most of the lease breaks are not being exercised, so that we will have the leases all the way confirmed running all the way till the end of the 10th year as much as possible. So we'll provide more updates when in due course on this particular activity. The next page. There's 2 pie charts here. The one on the left actually shows the tenancy breakdown. So our primary tenant I've gone through earlier is actually a department called Department of Works and Pensions that contribute to almost close to 90% of our gross rental income. We are cognizant about this concentration. We have also started acquiring assets that are actually used by other government tenants. So with the Maiden acquisition, you see the introduction of other departments such as the Ministry of Defence, Her Majesty Revenue and Customs, National Records of Scotland, HMRC, which is the Inland Revenue, the Natural Resources of Wales, Home Offices, environmental agencies, etc. So you do see that there are other users coming up on this pie chart, and that is actually the strategy of the manager. In future acquisitions, we will also try and diversify the concentration from DWP and making this, trying to make this as a more balanced pie chart as possible. Then on the right-hand side of this particular slides, you will see the breakdowns of our portfolio valuations in terms of locations. We have about 32% of our assets located in the London and the South East regions, about 18.7% in Scotland, another 18.3% in the Northwest, and the remaining percentages are constituted by the other parts of the UK. So it's actually a very well diversified portfolio. Next page. This particular slide shows the performance of our shares, or basically our units, since listing. We would say that we have always been steadily outperforming the S-REIT index throughout the period. Despite having gotten listed just for the onset of pandemic and all this activities of working with investors, working with other analysts, has all been gone into such situation like what we are doing now, the webinar style. It never actually stopped us from trying to reach out to investors and also reach out to anyone that is interested to know who we are. So I would say that we have been doing such webinars, sessions. We have also been attending forums. We will continue to do that and trying to engage investors as much as possible. We would like more people to understand what we are trying to grow, or our strategy for the REIT and how we plan to grow it. And similarly, we have also been able to get more research houses covering us. So you have seen that it started off with our original IPO bankers, which is UBS and CIMB, subsequently increasing UOB Kay Hian, DBS, and the latest was Maybank Kim Eng addition into the research coverage. So we'll continue with this effort and continue with our work with investors. The next page. So I think a few of the recognition of how we have been working. We have just been included by SGX onto the fast track program. It was just announced to us last week. These are all recognition of the corporate governance that the REIT is maintaining, or the REIT manager has maintained this particular REIT. We were also ranked joint 6 out of the 45 REITs in our first evaluation under the 5th Governance Index for Trust. We were also awarded by the ARC Awards for our inaugural annual reports. So these are the things that, apart from what we have mentioned earlier, apart from asset, apart from financial, we are very focused on as well, corporate governance, and also reach out to investors. The next page. So more of a general outlook in the UK, how does market look and how things are moving? This is a very short synopsis. The key points are that the UK GDP is expected to rebound in the last quarter of this year. Definitely, we've seen that the CPI index is increasing and is expected to increase further. The Bank of England has also decided that the main bank rate, to remain the bank rate in the short term currently where it is at this rate, but however, they do expect that they will be increasing the rates gradually. So we will be expecting certain small increases in lending rates in future. Then our rental escalations has all been linked to the CPI index, which has a floor and cap of 1% to 5%. So how does it work? What it means is that the rental rates uplift will be compounded based on CPI index, starting from 2018. When we first signed, the leases were first signed. So every year it will be compounded. The new rate will kick in on 1st of April 2023. So we have already compounded the actual based on 2018 to 2019, 2019 to 2020, and we expect to have 3 more years of compounding. So if the CPI falls below 1%, we will have a minimum of 1% uplift. If the CPI goes beyond 5%, we will be kept at 5%. So every year it will be added on, and the new rate will then effected in the end of the 50 of the lease. So that's how it works. Next page. Well, in terms of the main tenant itself and how the market is looking at it, is that the furlough scheme has ended at the end of 3Q. The DWP claimant counts in October was recorded at 2.08 million claimants. The government is still continuing to support the labor market in the near term. So we do expect that, things will recover over time. Will take some time for things to recover and to prior to before COVID situation. But indeed, the unemployment rate has not deep as much as people were worrying about. But having said that, the Department of Work and Pensions is still trying very hard to make sure that people could get back to work and to the workforce as well. So that's on the claimants. The next page. On opening up and vaccination, I guess UK has always been a forefront in terms of vaccination. Over 80% or more like 81% of the population has already been vaccinated. So they have been opening up. Things are getting a bit more back to normal. But winter is definitely approaching. I think it's getting quite cold now in the UK. It has also started snowing. So with the new variant coming up, everyone is very cautious. The NHS is also looking very closely at the situation, and adjustments into policy might change should there be any high alert. But having said that, currently everything is still moving as per what they have planned out in terms of opening up to outsiders as well. So next. So moving forward, we will continue to provide very stable income to our unit holders. This is what we have done despite COVID. We will remain very focused to grow the REIT, and this will be mainly coming from acquisitions of assets. It will be through either a third-party acquisition directly from the market, or it also could come from the ROFR assets, which is the right of first refusal assets, which the sponsor has in hand or they are managing. And we have also announced that the manager fees will be collected in the form of cash starting from next year. So that will help us to balance out the financial position in the long term, strengthen the REIT's financial position more in the longer term. So I guess that's what we are looking at moving forward. That comes to the end of the presentation. I would like to then open the floor to any questions that you may have, and my team will join me to answer any queries.
Thank you, Shaldine, for the very informative presentation. I am Hong Yin, Investor Relations Officer from Elite Commercial REIT Management. And on behalf of the team, a warm welcome to our sharing session today. Thank you for spending your precious evening with us today. So next up, we will open the floor for questions and answers. This question, please kindly type your questions into the chat box and we will read out your questions. Well, I have my pleasure with me to have Shaldine, Joel, and Jonathan with us in this question and answer session. Okay, first up, we have a stream of questions coming in. Right, so well, the first we have the question from about the yield. So the yield of Elite Commercial REIT seems higher than the UK regional office prime yield. Could you share with us on the reason for this and if this is sustainable?
Yeah, I mean, I can take that question as long as you can all hear me clearly. The yield quoted for UK regional offices, often that's the prime yield for for grade A offices in city centres around the UK, in major cities, not just outside of London, but also Manchester, Birmingham, Bristol, Leeds, Newcastle, etc. Our properties are located kind of all across the UK. So whilst we have assets that are in London and as well as in these regional cities, we also have assets that are located in smaller towns across the UK, all the way from northern Scotland to the south of England and from deep into Wales across to the other side of the country. And because of these locations, the REIT offers a slightly higher yield than market. And that's just really driven by investor appetite for buying assets in these locations, which means the yield is higher. That's not to say that the income is not sustainable. As Shaldine has explained, these assets are relatively unique. The tenant who uses them has a unique requirement for properties in these locations. And often these are the best and only properties that are able to service the tenant's needs in these locations. So in fact, the yields for this portfolio are potentially more sustainable than those in regional cities, which is where the market yield is quoted. So that's the explanation for why the yields are a bit higher, but it doesn't detract from the fact that the yields in this portfolio are also highly sustainable.
Thank you very much, Jonathan. I think the next question is about also from Jo Chen. If the assets and client is so stable, why did the REIT outperform projection in the range of 60 to 70% after 1 year of listing?
No, should I hand to Joe?
Yeah. Thanks. I will take this quite quickly because we have actually completed our maiden acquisition of 58 assets as of March 2021. So that itself propels the rental top line to increase by 60-70% compared to what we had projected. So we wanted to, when we were out of the gate, we wanted to deliver growth to the investors, and this is something how we have been trying to deliver growth, and that's through the maiden acquisition. Yeah.
Thank you very much, Joel. I guess the next question would also go to you. So based on your latest results, latest business update, your aggregate leverage is around 42.1% with only GBP 30 million debt headroom remaining. I guess your future acquisition is likely to be financed by equity to some extent.
Yeah, I think this one, I thank you for the question. I think the REIT definitely has a long-term gearing target of less than 40%. So when we were acquiring the maiden acquisition, we did present to investors two possible scenarios. One being fundraising factored in, the other funded fully by debt. Because bear in mind that when the acquisition was done, it was actually in the midst of COVID, and we are still in COVID. And so we wanted to make sure that we have a plan A and plan B for finishing the acquisition. So today we have completed the acquisition with mostly debt funded, and that brings our gearing to about 42.1% currently. It's a bit slightly higher than what we have our long-term target, but definitely the goals of the management is to bring that down over time. And that one of the very, very logical way to do so is to raise a bit more equity in the next acquisition so that we can repay some of the loans alongside the acquisition. So I hope that addresses the gearing question and goal. Yeah.
Thank you, Joel, for the question, for the answer. Okay, so next to take on from there would be a question from Kamal Khan. Does the REIT directly buy new assets or the funds which then later become part of the REIT? When are the next assets expected?
Yeah, I think this is with regards to acquisitions. We do have got, like I mentioned earlier, there is opportunities to directly buy assets in the open market. It's a very open market in the UK. The government doesn't really own a lot of government assets. It has been, they have gone asset light back in 1990s. So a lot of the assets are actually held in the hands of investors. So it's a very actively traded market in the UK. So we are possible to acquire directly from the market. Now, having said that, we have acquired our first acquisitions, which is actually from the sponsors as a Rover Pipelines. Well, as a small REIT, if we are going to amalgamate a huge pot of properties to acquire, it's not as quickly as we always have to do fundraising and stuff like that. So what the sponsor has actually helped us was actually they put it into a private fund. When we are ready, we can actually make an offer to say that can we buy them. We are buying it based on the valuations as well, and of course, because it's a Rover Pipelines, we always have got two valuers justifying the valuations when we did the acquisitions. So yes, it can be two ways. It can be acquired through funds that the sponsors have set up to help us hold certain assets. It could also be directly from the market. So John has now been relocated back to the UK a few months ago. He has been looking very attentively into the market as well on the potentials for future acquisitions. So it could be both.
Yeah, I think the plan absolutely is to grow. There's a big portfolio of the UK government is the largest occupier of real estate in the UK. They went asset light in the mid-90s, so there's a large pool of investable stock in the UK for us to acquire. We are as our business develops, we are deepening our knowledge of the way our main tenant, the UK government, works. So what we're looking to do is to try and find assets that offer, those long-term sustainable income at relatively, good yields that will be accretive to the REIT portfolio. So as we build up, knowledge, we'll be able to acquire assets more, that have a high likelihood of delivering the returns that the investors want. But we see that there's a good opportunity for us to grow in the UK. That having been said, we're focused on asset management at the moment, and we'll hope to follow up with some acquisitions during the course of next year.
Thank you, Shaldine and Jonathan, for the answer. And now, if you may allow me to group a number of questions regarding the lease break option. So the gist of them: have you done a risk assessment of tenants who may exercise their lease break option in 2023, and are you able to share your assessment?
So it's a very good question. This is something we have been, I think we've been advising investors on since we acquired the portfolio. We have undertaken a risk assessment of the, of all the assets in the portfolio where there are lease breaks. We've looked at, we've been working extremely hard to collect as much information as we possibly can about these assets, not just from the basic property fundamentals like rent and yield and other aspects like that, but also looking at how the tenant utilizes these buildings. We developed a system of analysis which helped us quite clearly understand how the government was using the tenant was using these buildings, and we realized that based on that analysis, we thought that there was an increased likelihood that the tenant would require these buildings beyond the 2023 break, and that's what we're in discussion with the tenant about at the moment. This is subject to a non-disclosure agreement for reasons of sensitivity, but we hope to come back to investors in the new year just to provide a response on that. And I think our guidance on this point is that we expect a reasonable outcome that will allow the REIT to continue to offer stable returns to investors. So this is something we're actively working on, and we look forward to updating investors on the outcome of these discussions in due course.
Jonathan, yeah, there's a couple of questions on a similar topic. If I may read them out. So as the assets, how does the management assess the lease extension risk given the large exposure to DWP? And as the assets are uniquely placed to cater to tenants' needs, how easily are those assets be able to be leased out to other tenants in case of this break?
Yeah, I mean, these buildings are just standard office buildings, that they're capable of being let to any commercial tenant. As we've discussed, explained previously, these assets are in a wide variety of different locations where there is, greater or less demand from commercial tenants for office use. But we look at each asset on a case-by-case basis, and whilst we, there are some assets that present very well for remarketing as office buildings. But there is a significant number of properties in the portfolio that offer the potential for, for value growth through the predominant alternative use is into residential, and many of these assets have the automatic right to be converted into residential. Not that the REIT would do that, but in terms of understanding the value, we need to know where that residual value lies. So, the most important thing is that we'll be looking at these assets on a case-by-case basis and determining the strategy that generates the best outcome for the REIT. And there are lots of options with these assets. As Shaldine mentioned earlier, these properties are often located in towns and city centres close to public transport as well as retail amenity. They've often got large car parking spaces, which means that they've got capacity for extension. So, there are definitely some good opportunities to drive value, which will offset some losses where assets are vacant, become vacant, and they're harder to re-let. So it's not all one-way traffic, but in terms of a positive outcome. But we think that's going to be a net positive outcome for investors, as we work through each asset individually.
Yeah, I think one example, a live example, is actually the Epsom property, which we have announced earlier. This is an example of why there are alternative uses, and buyers are willing to pay higher than what we have on our book value on the assets. It remains as a government use. So these are some of the examples of what the asset can be used for, and particularly because of the ability to convert it into other usage, it presents a different value as well. So that's what we want to share with investors.
Thank you, Jonathan and Shaldine. Also, on a similar topic, can you provide a contrast of what kind of rental income similar properties are delivering versus current levels from the main tenant?
Yeah, I mean, this is something we've looked at quite closely, because the rental level in the portfolio across the portfolio is £10 per square foot per annum. On a basic level, you can't, the economic rent for new build in the UK, as in the minimum rent you need to be able to achieve in order to justify construction costs, is more like £20 per square foot. So, for that reason, the level of rents that we're charging are, automatically considered to be affordable. And there are some good examples in our assets in Glasgow, for example, in the Glasgow Benefit Centre. The rent being paid is closer to £18 per square foot, whereas the market is upwards of £30 per square foot in the same location. Our building is a bit older at the moment, and the condition of the property internally doesn't warrant charging £30 per square foot in terms of rent. But that's the potential for for this building once we undertake a refurbishment to drive the rental up to that level. What we're not saying is that these assets are massively under-rented at the moment. But what we are saying is that the assets have potential to generate higher levels of rent if we can undertake refurbishments.
Right, excellent. Thank you very much, Jonathan. And okay, next to the next question, would it make sense to pull forward some of the possible lease breaks to new agreements, which maybe in fact smoothen out the break risk?
I think this is something that we like to look at where there is potential, and again we'll report back. This is probably subsequent to any discussion around the break clause, the early termination rights, but it has already been contained as included in the discussion with the tenant for future discussion.
Okay, and then the next question by Joe. As you look at acquisitions, are you expecting equity raises or right issues in 2022?
I think let me just take this quickly. So it really depends at a point in time. So I think in strict terms, it depends on the current prevailing market price of the share. It depends on the quantum that we're raising. And eventually, it also could be a linear way, either via placements or via rights, or it could be a hybrid. So there are many factors determining all this. And I guess the manager would, in consultation with our fundraising bankers, would come to a decision in terms of what would be the most efficient way to tap the market, and making sure that, hopefully, making sure that investors can also participate in the growth as well. And for retail investors who have already been invested in us, one of the ways that you can participate in the growth of the company could be via the participation of DRP. So that has been implemented since June this year.
Move on to capital gains. So what is the capital gain potential of your assets? What has been the trend in the last 3 years? Are there any new developments around your assets which may pull your existing tenants to the new properties?
There are a few trends there. In terms of capital gains, we think the main driver for two main drivers for capital gains in this portfolio are associated with valuation increases. It will come from either removal of lease breaks, so that's a discussion we're actively engaged with, and number two, through additional rent escalation that's going to come through as a result of where inflation is heading in the UK. You may remember or have from Shaldine described previously that the leases contain a rental escalation that's linked to CPI, the CPI index, inflation index in the UK, where the rent increases in 2023 at a compound rate over the last 5 years in inflation. So up until recently, the inflation forecast in the UK for 2021 to 2023 was close to sort of 2%, but that's now increased significantly and is currently looking at it like it will hit the upper limit of 5% at least for the next year, and that's going to significantly increase the amount of rental escalation that comes through in 2023. We originally guided that the minimum rental increase was likely to be about 8% in 2023 for leases that continue through until 2028, but we think that that's more likely to be a minimum of about 9.5% based on current expectations, and that future income escalation rate should help grow the value of the portfolio today. In terms of other developments that may pull the tenant away into alternative assets, the tenant has been expanding its portfolio to deal with COVID and employing more people, and there is a risk in a handful of the assets that the properties that they've acquired may present an alternative option for them to relocate to in the future. Our analysis suggests that this is a small number, and where the risk is highest, actually, we know that the tenant is paying significantly more rent in the other buildings, which gives us the ability to incentivize the tenant to try and stay in our buildings, which is the strategy that we'll be employing.
Yeah, maybe just add on from there. I think that was also relates to one of the questions and that was in the list, is that actually the government has been in these buildings for a long, long time. Like we said earlier, the government actually has gone asset light in the 90s. Well, most of the buildings are not newly built. Ours youngest is probably about 10 years old in terms of our portfolio. So the government definitely has been in this building easily 20 years or more. Definitely in terms of the time that they're spent in these buildings, it has been a long time. So it's not that easy for a government to actually decide where to easily move out of a building. They do need to have due considerations before they actually do that move.
Thank you, Jonathan and Shaldine. Okay, there's one more question. Would you expect the REIT to have increasing trading volume in the near term?
Okay, let me take that. I guess liquidity is something that the manager is quite focused on. We understand that the size of the vehicle is slightly smaller, so that's why that's a proportional impact on liquidity. So what we have done is that we have actively engaged retail investors, institutional investors. We have also done a lot of industry-wide events, like symposiums, webinars, and stuff like that, with the aim of increasing liquidity and focus. So I think liquidity is a long-term issue. It's a long-term matter that I think the manager is aware of, and what we can do is to create more investor awareness, more investor education. On top of that, just proving ourselves along the way with track record, for example, getting some corporate governance award along the way, growing the portfolio by doing acquisitions. That all in all would slowly build the track record and build the following. So I think it's one thing to love the liquidity flowing in, but we also cognizant of the fact that it takes time to build it up and it takes time to build that brand and following. So we are very cognizant of this, and we are definitely putting a lot of effort in making sure that we are getting this across the market.
Thank you, Joel. And one more question, any plans to grow up quickly so as to be able to compete more effectively?
We definitely want to grow up quite quickly so that we can actually attract more investors as well. And that definitely helps in liquidity, like what Joel has mentioned earlier. We have actually almost not double, but close to. We were looking at the portfolio where we wanted to acquire. We will have to manage it because otherwise it becomes a VSA acquisitions. So I guess we have shown that the REIT has been able to increase its size from the original 313 million pounds, 15 million pounds to 500 million pounds. I guess it's almost like a more than 200 million pounds increase in our asset size. We are looking at, like what John says earlier, we are actively looking at asset management, ensuring that we can continue the dividends and also the payments back to unit holders at a current level or even better. And of course, the next will then be looking at the acquisitions to grow. So we are looking at pipelines. So we hope that definitely in the new year, we will be coming back to investors to let you know that there are acquisitions coming along the way.
Thank you, Shaldine. And I think we have some questions. We have some questions about the presentation slide. So to assure all participants today, we will be sharing the slides on our website and the SGXnet. So you can look out for it. And we would also like to invite you to follow us on our LinkedIn page, and also sign up for the email alerts on our website.
Just to add on to one point, I think if I guess the investor correctly, you're asking about whether Malaysian investors will get the same kind of financials as Singaporeans are getting. So we have checked this since IPO days. So we checked this at IPO days. So we are aware that Malaysian investors and Singapore investors will all get the same tax treatment. So in other words, you will get dividends that is tax exempt. So that means whatever dividends that a Singapore investor is getting will be quite similar to what Malaysia is getting because of the double tax treaty between Malaysia and the UK. So that one is it's just how I'm trying to guess what question you're asking here.
Thank you, Joel, for the answer. Yeah, so I'm cognizant of the time. We are now at 7:30. So any other last questions? We are happy to take it. Otherwise, we would like to thank you very much for all participants today. Thank you very much to the management, Shaldine, Joel, Jonathan, and also to UOB Kay Hian side for helping to organize this event. And I hope that you have a great and pleasant week ahead. Thank you, everybody.
Thank you, everybody.
Thank you.